Germany is deindustrializing, and no one wants to admit it. The economic engine of Europe is seizing up, and it's not a recession, it's a fatal, structural failure. Germany's world-beating industrial machine is being deliberately dismantled by energy policy and bureaucracy. The unthinkable is happening. The end of the German economic miracle. Germany, the financial and industrial anchor of the Eurozone, is undergoing a profound and potentially irreversible deindustrialization process. This isn't a temporary cyclical downturn. It is a structural implosion driven by a toxic convergence of geopolitical shock and disastrous domestic policy. The core hidden truth is that the German economic model built on exporting high-value goods subsidized by cheap Russian pipeline gas has been permanently rendered non-viable. The primary catalyst is the energy cost shock. The disastrous Energiewende, energy transition, which eliminated stable nuclear power while simultaneously becoming dependent on Russia, exposed German industry to catastrophic price volatility. Energy-intensive sectors, chemicals, metallurgy, and auto manufacturing are now structurally uncompetitive globally, with costs 2 to 3 times higher than those in the US and China. This has led to a strategic capital and production exodus, as firms like BASF relocate capacity to more favorable jurisdictions. Compounding this is the severe productivity and demographic crisis. Germany faces some of the worst demographics in the G7, guaranteeing a crushing pension and healthcare burden on a rapidly shrinking workforce. Simultaneously, bureaucratic overload and underinvestment in digital infrastructure stifle the productivity gains necessary to offset high labor costs. For the investor, the consequences are clear. The Eurozone has lost its guarantor. A weakening Germany cannot underwrite the vast debt of the southern periphery, Italy, France, turning the Eurozone into a highly volatile structure. We will dissect the 4 fatal flaws confirming this deindustrialization, revealing the point of no return for Europe's anchor and the actionable wealth strategies to hedge against the impending collapse. To gain the ultimate advantage from this looming crisis, stick around and make sure you subscribe to Secret Wealth Tactics. The narrative of German economic prowess, the Wirtschaftswunder, or economic miracle, has for decades served as the unchallenged anchor of the European Union and the ideological validation for the Eurozone project. This strength, epitomized by its high-tech manufacturing, export surplus, and fiscal rectitude, was perceived globally as an immutable truth. Yet, today, Germany is experiencing a profound and potentially irreversible crisis: deindustrialization. This is not a cyclical downturn, it is a structural implosion, and its single, most immediate, and most lethal catalyst is the energy cost shock, the fatal flaw that has permanently shattered the German industrial model. The hidden truth about the German economic success story is that its high-value export machine, while globally renowned for quality and engineering, was secretly and structurally subsidized by a critical input: cheap, stable Russian pipeline gas. This energy source provided 2 non-negotiable advantages: price stability, insulated from the volatile global LNG spot market, and low-cost abundance. This enabled Germany's energy-intensive backbone industries, chemicals, metallurgy, glass, ceramics, and heavy manufacturing to produce high-quality goods at cost levels that were globally competitive. The ability to produce industrial inputs, like ammonia, essential for fertilizer and chemicals, and basic metals cheaply, was the foundation upon which Germany's massive, downstream export sector, particularly the automotive industry, was built. The catastrophic rupture of the German-Russian energy relationship, following geopolitical events, did not merely cause a temporary price spike, it created a permanent, structural disadvantage for German industry. The country has been forced to replace pipeline gas with expensive, volatile, liquefied natural gas, LNG, purchased on the global spot market, often competing with high-demand Asian buyers. This shift has resulted in a fundamental and lasting repricing of industrial inputs. The financial reality is devastatingly simple. German industrial energy costs are now structurally 2 to 3 times higher than those faced by competitors in the United States and large parts of Asia. The United States, benefiting from its shale revolution and the Inflation Reduction Act, IRA subsidies, offers cheap, abundant, and stable domestic natural gas, making it the world's most attractive destination for energy-intensive manufacturing investment. German industry, once a global cost leader, has become a high-cost outlier. This cost differential guarantees a systematic industrial atrophy and production exodus. For companies whose energy consumption represents a significant portion of their operating costs like BASF and chemicals, or major steel and glass producers, the new price reality makes continued operation in Germany economically irrational. The predictable corporate response is not to cut production temporarily, but to permanently relocate capacity and future capital expenditure to jurisdictions where energy costs are low and subsidized, such as the U.S. Gulf Coast. This is not temporary belt-tightening, it is the permanent loss of high-value manufacturing capacity, which shrinks the productive core of the German economy and destroys its long-term export potential. The crisis is compounded by the colossal failure of the German government's domestic energy policy, the Energiewende. The political decision to phase out stable, low-carbon nuclear power before securing adequate renewable capacity or storage was a fatal strategic blunder. This policy, driven by domestic political consensus rather than engineering and economic reality, ensured that when cheap Russian gas was abruptly cut off, Germany had no viable, stable, low-cost domestic alternative. This dependence forced the nation back onto highly polluting, expensive alternatives like coal and the volatile global LNG market, directly guaranteeing higher domestic electricity prices and increased carbon emissions, a complete failure of the policy's stated goals. The consequence for the Eurozone is profound: the loss of the financial anchor. For decades, Germany's massive export surplus and fiscal strength were the implicit guarantees of the single currency. Germany's industrial strength generated the capital flows, the safe haven asset demand, bunds, and the fiscal capacity needed to underwrite the debts and banking systems of the Eurozone's more fragile periphery: France, Italy, Spain. As the German industrial core shrinks and its competitiveness evaporates, its ability to function as the Eurozone's indispensable guarantor is critically compromised. This deindustrialization is a systemic disaster because it creates a direct, unmanageable feedback loop: high energy costs, dollar, right arrow dollar, industrial exodus dollar, right arrow dollar, shrinking tax base dollar, right arrow dollar, higher sovereign debt dollar, right arrow dollar, Eurozone instability. The German economic miracle is not merely slowing down. Its fundamental, non-renewable source of competitive advantage has been destroyed, and the political system's self-inflicted wounds have sealed its fate. The unthinkable, the end of German industrial dominance, is happening, and it transforms the entire risk profile of investing in the Eurozone. The catastrophic energy cost shock, detailed previously, while the most immediate and fatal catalyst for German deindustrialization, is not an isolated event. Its devastating impact is compounded and cemented by the second, equally debilitating flaw in the German economic structure: a profound and pervasive productivity and regulatory paralysis. This paralysis is characterized by a crippling combination of chronic underinvestment in essential digital infrastructure, a suffocating bureaucratic load that acts as a tax on innovation, and a stubborn adherence to labor models that are increasingly mismatched with the demands of the modern, high-speed, global economy. This structural rigidity ensures that Germany is incapable of generating the productivity gains necessary to offset its soaring energy and labor costs, guaranteeing a long-term decline in competitiveness. The first critical component of this paralysis is the nation's alarming digital infrastructure deficit. Germany, the industrial heartland of Europe and a global leader in high-tech manufacturing, ironically possesses digital infrastructure that lags significantly behind many of its developed peers, particularly in the ubiquity of high-speed fiber optic broadband. This deficit is a direct drag on productivity in the 21st century. While German manufacturing plants boast state-of-the-art automation, the bureaucratic and domestic service sectors remain hampered by slow connectivity and paper-based processes. For an economy that must transition from relying on cheap physical inputs, gas, to relying on superior intangible inputs, data, connectivity, AI, this deficit is a monumental barrier to modernization. The slow rollout of 5G networks and fiber-to-the-home connectivity translates into higher operational costs for digitally reliant businesses and hinders the mass adoption of remote work and efficient digital public services. Compounding this infrastructure deficit is the notorious bureaucracy drag. The German administrative system, once lauded for its thoroughness and reliability, has devolved into a suffocating barrier to agility and innovation. The regulatory environment is characterized by complexity, redundancy, and slow decision-making processes. Starting a business, Obtaining necessary permits for construction, for example, building a new factory or energy installation, or gaining approval for technological innovation, is a notoriously protracted and costly process. This bureaucratic overload acts as a de facto regulatory tax on entrepreneurship and investment. Companies are forced to dedicate extensive resources, time, capital, and legal expertise to compliance and paperwork rather than to innovation and capacity expansion. This stifles the emergence of the next generation of high-growth German Mittelstand firms, which are critical for future economic diversity, and prevents existing firms from reacting quickly to global market shifts. This rigidity is directly contributing to a deepening productivity crisis. Productivity output per hour worked is the engine of long-term economic prosperity and the only sustainable way to maintain a high standard of living. Germany's productivity growth has been lackluster for years, but the situation is now critical. The high cost of German labor, supported by a strong social safety net and powerful unions, is only economically viable if output per worker remains exceptionally high. When productivity stalls, and labor costs remain fixed, or rise, due to inflation, the cost of producing German goods becomes structurally prohibitive. The situation creates an impossible economic squeeze. German firms are losing their cost advantage on the input side, energy, and failing to generate sufficient efficiency gains on the output side, productivity. This guarantees a sharp decline in international competitiveness, particularly against the US, with low energy costs and high agility, and China, with massive scale and state-backed technology. The burden of this productivity stagnation is increasingly borne by the profitability of the corporate sector, which is already under pressure from energy costs, leading to reduced investment and a deepening cycle of decline. The automotive sector's existential crisis serves as the most potent example of this paralysis. Germany's automotive industry is its most crucial export sector and a cornerstone of its industrial identity. However, the transition to electric vehicles, EVs, has exposed the sector's deep structural vulnerabilities. While German engineering remains world-class, the high domestic energy and labor costs, coupled with the regulatory drag, make it incredibly difficult for German manufacturers to compete effectively against rivals who can scale up battery production and secure raw materials more cheaply and rapidly. Furthermore, the slow pace of digital infrastructure development hinders the necessary integration of complex software and connectivity into next-generation vehicles, an area where US and Asian competitors already hold a commanding lead. The inability to rapidly pivot and innovate, hampered by labor rigidity and regulatory hurdles, threatens to undermine the entire industry. Ultimately, the productivity and regulatory paralysis ensures that German deindustrialization is a one-way street. The structural impediments prevent the necessary market adjustments, rapid digitalization, investment in new efficient capacity, and swift bureaucratic reform that could partially offset the crippling energy shock. The German system, once a source of stability, has become its own worst enemy, a rigid, slow-moving apparatus that is structurally incapable of adapting to the speed and cost pressures of the 21st century global economy, thus guaranteeing the prolonged decay of its industrial core. The structural decay of the German economy, accelerated by the energy cost shock and cemented by productivity and regulatory paralysis, is rendered terminal and unfixable by its third, most profound flaw: the ticking demographic and fiscal time bomb. This is an existential threat that transcends economic cycles and political choices, representing a harsh mathematical certainty that guarantees Germany's long-term financial insolvency and compounds the risk facing the entire Eurozone. Unlike the transient effects of policy, this crisis is based on biological facts that cannot be reversed by legislation. The fundamental catastrophe is Germany's demographic time bomb, driven by one of the lowest birth rates and highest life expectancies in the developed world. While post-war Germany rebuilt its industrial base, it failed to sustain its human capital base. The shrinking fertility rate over decades has created a fundamentally inverted population pyramid. This demographic imbalance has two catastrophic financial consequences. First, a rapidly shrinking tax base and workforce. As the large cohorts of the baby boomer generation move rapidly into retirement, the proportion of the population that is actively working, paying income taxes, and contributing Social Security, national insurance, is declining at an alarming rate relative to the total population. This constricts the economy's potential for organic GDP growth and places an increasingly severe burden on a smaller base of younger, active workers. The worker-to-retiree ratio is plummeting, which means the nation's capacity to generate the revenue necessary to fund its commitments is shrinking precisely when its expenditure obligations are peaking. Second, exploding mandatory social liabilities. The shrinking workforce must fund the social safety net for a rapidly expanding elderly population. This creates geometrically increasing costs for two key statutory obligations: pensions. Germany's pay-as-you-go pension system relies on current workers funding current retirees. The deteriorating dependency ratio guarantees that the pension system will require massive, continuous, and increasing transfers from the general federal budget simply to remain solvent. Healthcare. An aging population necessitates exponentially more complex, chronic, and expensive medical care. Healthcare expenditures are mandatory and politically sacred, ensuring that the cost of Germany's comprehensive universal healthcare system will continue to surge, consuming ever larger portions of the nation's wealth. These mandatory, demographic-driven expenditures create an immediate and powerful fiscal squeeze on the federal budget. Non-discretionary spending on pensions and healthcare crowds out productive public investment in areas crucial for future growth, such as infrastructure, R&D, and education. This reinforces the underinvestment trap that plagues German competitiveness, creating a self-perpetuating cycle of fiscal strain and diminished future capacity. The demographic time bomb transforms Germany's existing high levels of sovereign debt into a systemic solvency crisis. While Germany has historically maintained better fiscal discipline than its southern European counterparts, its national debt remains substantial, and its borrowing needs are now increasing dramatically due to massive expenditure on energy subsidies, defense, and social care. The core financial reality is that the future tax revenue required to service and ultimately reduce this debt is structurally undermined by the shrinking workforce. Debt that might be manageable with a growing, young population becomes unsustainable when the tax base is in permanent decline. The market will eventually price in the fact that Germany lacks the future productive capacity to generate the wealth needed to cover both its explicit debt and its massive, unfunded liabilities. The scale of these unfunded liabilities is the true, hidden dollar text euro trillion-dollar catastrophe. Beyond the official sovereign bond debt, Germany carries enormous unbooked obligations for future state pensions and healthcare commitments. These obligations are political and legal promises that must be honored. When estimated using standard actuarial methodologies, these future liabilities dwarf the current national debt, representing a vast shadow debt that future generations of German workers are legally required to fund. This looming obligation ensures that the political promise of maintaining the generous social contract is mathematically incompatible with Germany's future tax capacity. This demographic certainty dictates the political paralysis and policy failure that is now endemic in Berlin. The German government is caught in an intractable political dilemma: massive tax hikes. Raising taxes to the level necessary to fund both the debt servicing and the exploding social liabilities would place an unbearable burden on the shrinking working population, accelerating the flight of skilled labor and capital, and plunging the economy into a deep depression. Draconian spending cuts. Cutting mandatory spending on pensions or healthcare is politically suicidal and would violate the core social contract, potentially leading to social unrest and political instability. This policy paralysis guarantees that the government will continue its path of least resistance, funding the gap with new borrowing. This means that Germany's debt-to-GDP ratio will continue its inexorable rise, even as its productive capacity shrinks, cementing its transformation from the Eurozone's indispensable anchor to its most profound structural vulnerability. For the Eurozone, the financial implications of the German demographic and fiscal time bomb are terminal. The bloc was designed to rely on German financial rectitude to enforce discipline and underwrite risk. If the economic engine of the continent is itself rendered fiscally insolvent by immutable demographic facts, it loses the capacity to rescue the highly indebted periphery: France, Italy. This final structural flaw confirms that the entire Eurozone project is resting on a rapidly decaying foundation, guaranteeing that the failure of its core will eventually translate into the systemic collapse of the single currency. The thorough examination of the German economic model, which revealed the catastrophic energy cost shock, the debilitating productivity and regulatory paralysis, and the existential threat of the demographic and fiscal time bomb yields one decisive, yet widely unacknowledged, conclusion. The German economic miracle is over. This is not a cyclical recession from which a rebound is expected. It is a permanent, structural collapse of the fundamental competitive advantages that underpinned German industrial might for the last half-century. Germany is undergoing an irreversible process of deindustrialization, losing its capacity to act as the stabilizing financial and economic anchor of the European project. The synergy of these three fatal flaws guarantees a prolonged era of decline. The loss of cheap Russian gas has permanently elevated input costs, forcing energy-intensive sectors to undergo systematic production exodus. This exodus is being paid for by a working population that is rapidly shrinking due to catastrophic demographics, ensuring that the fiscal burden of mandatory pension and healthcare spending will crush future budgets. Simultaneously, rigid labor laws and suffocating bureaucracy prevent the agility and innovation necessary to transition the economy to high-value, digitally driven sectors. Germany is thus trapped in an unavoidable financial and industrial squeeze. Its revenues are shrinking, its costs are soaring, and its ability to adapt is paralyzed. The critical realization for the global investor is that the failure of the Eurozone is no longer a peripheral risk, for example Greece or Portugal. It is now a core solvency threat. A deindustrializing, financially compromised Germany loses the ability and the political will to underwrite the massive debt of the rest of the bloc, specifically France and Italy. This transforms the entire Eurozone from a stable currency union backed by a strong industrial core into a highly volatile structure underpinned by two weakening high-debt anchors. The Euro-EUR, therefore, becomes structurally vulnerable to systemic failure. The strategic imperative for any investor or wealth manager with exposure to Europe is to hedge decisively against German structural decay and the resulting instability of the euro. The goal is to avoid being a victim of the collapse of the continent's largest economy and, instead, to strategically position capital to benefit from the ongoing global flow of investment away from high-cost, high-risk jurisdictions. Wealth strategy. Hedging against deindustrialization and collapse. The comprehensive wealth strategy must focus on three core objectives: strategic euro avoidance, tactical shorting of industrial atrophy, and long-term capital migration. 1. Strategic euro avoidance and hard currency bias. The euro is the most exposed currency to the confluence of high energy costs, zero growth, and sovereign debt risk in its core. Its value is now a proxy for German industrial health, which is in terminal decline. Actionable strategy. Long USD, short EUR bias. Maintain a significant, structural portfolio bias toward the US dollar USD. The US benefits from energy independence, massive corporate subsidies, IRA, CHIPS Act, and remains the indispensable safe haven for global capital fleeing European chaos. Every euro-denominated asset must be scrutinized for its true currency risk. Actionable strategy. Physical gold and commodity exposure. Increase allocation to physical gold and hard commodity producers. Gold is the ultimate, non-jurisdictional hedge against the systemic failure of sovereign debt and the final collapse of fiat currencies. Commodities, energy, raw materials are essential, and their pricing power provides a shield against the inflation that inevitably results from supply chain chaos and massive government subsidies required to prop up struggling sectors. 2. Tactical shorting of industrial atrophy. Profit directly from the structural failure of the German economic model by identifying the most vulnerable sectors. Actionable strategy. Short energy-intensive industrials. The ultimate trade is against those German companies in sectors like chemicals, basic materials, steel, cement, and specialized engineering that cannot profitably compete at current energy prices. Their production exodus is permanent, guaranteeing long-term erosion of capacity and stock value. Tactical short positions or inverse ETFs, focused on the DAX's most industrial-heavy components, are a direct bet against the failed energy policy. Actionable strategy. Avoid German banking and automotive OEMs. The large German automotive original equipment manufacturers, OEMs, face crippling competition and high transition costs, making them high risk. Furthermore, German banks, while historically conservative, are deeply exposed to the solvency of the core industrial sector and the peripheral sovereign debt, making them vulnerable to a sudden, systemic contagion. 3. Long-term capital migration and IP capture. Position capital to benefit from the continuous geopolitical flight of investment and talent away from Germany. Actionable strategy. Invest in the U.S. Investment magnet. Direct capital into U.S. firms, benefiting from the IRA and cheap energy. This includes U.S. based industrial real estate, logistics, and manufacturing companies that are either receiving subsidies or servicing the influx of capital and production fleeing Europe. The U.S. is capturing both the capital and the intellectual property IP, fleeing the rigid German system. Actionable strategy. Focus on German niche global exporters. The only resilient German firms are those hyper-specialized middle-stand companies that maintain a global monopoly on a niche technology and generate profits almost entirely outside of the Eurozone, effectively using global revenue to subsidize their high domestic costs. These firms are few, highly specialized, and demand intense research, but offer deep defensive value. Final call to action and next video tease. The German economic miracle is not merely suffering, it is being dismantled by a self-inflicted convergence of fatal structural flaws. The energy cost shock has set the process in motion, and the demographic and fiscal time bomb guarantees the terminal outcome. The single most important financial implication is the loss of the Eurozone's anchor, transforming the continent's debt crisis from manageable to existential. You have witnessed the detailed evidence. The unthinkable is happening. Ignoring this reality means accepting exposure to a systemic financial risk, the scale of which has not been seen since the launch of the euro itself. Your financial resilience depends on moving faster than the market's realization of this catastrophic decay. Do not be a spectator in the collapse of the world's most powerful industrial economy. If you are ready to implement these high-conviction, actionable strategies to shield your wealth from the coming European shock and profit from the chaos, then you must align yourself with those who understand the true flow of global power and capital. Secure your knowledge. Act now. Subscribe to Secret Wealth Tactics right now and turn on those notifications. We will guide you through the systemic changes, ensuring your capital is positioned for unparalleled success in the emerging New World Order.